Okay, investors, turn on the financial news, and most days you'll hear someone talking about markets being highly volatile and uncertain, and more often than not, you'll also see the interview nod in agreement. With 2026 being the second year of a presidential cycle, the dreaded midterm election year, historically, while posting positive returns, these midterm years, like we are in this year, have elevated levels of volatility and exaggerated seasonal swings and returns. English language translation, the highs and lows, the ups and downs in the indexes throughout the year tend to be wider and have more frequent swings. Some years the market and the returns it generates feel volatile, but aren't mathematically that far off a normal year. Over the last 5 years, an investor had to endure minus 27.5% peak to trough decline in the S&P 500 in 2022, and another Trump tariff dump of minus 21% last year in April, with over 10% of that coming in less than a week. That's out of the ordinary volatility. But investors know that the longer-term reward for investing in equities is the return. The risk is enduring the downside volatility at times. Here's the data from Charlie Biello on annual drawdowns and their frequency. A minus 5% decline in the S&P 500 happens nearly every year, while minus 10% decline happens nearly every 18 months. So, are the markets really more volatile than they have been, or is the financial media guilty of making investors feel more volatility? Look at the data. Bear market decline of minus 20% happens a little over once every 4 years, while a recessionary decline of 30% or more happens 1 out of 10 years. With these stats in mind, it brings me to this week's topics. Market volatility, what you're feeling, what's happening, and what we're seeing over the next 4 to 6 months. Let's talk about different bond volatility first. I like to follow a measure of Treasury bond market volatility. This is an index we've discussed many times in the last 5 years, the MOVE index. I consider this ground zero for the collateral markets that many institutions use to leverage and trade their portfolios on margin with debt to try to amplify their returns. I've discussed this index in the past during times of severe market stress and forced investor selling in both stock and bond markets by those margin clerks under the headline, collateral damage. As U.S. Treasuries are supposed to be the safest, risk-free asset in the world by which every other public and private market financial product is measured. Here's a chart of the MOVE index over the last 15 months. It's down and to the right, in a very bullish downtrend for bonds and collateral markets. That's pretty contrary to most of the talk I hear on financial news about how unhinged the Treasury markets are. And bond volatility pick up here for a few months if the tariffs get overturned, or if Fed independence becomes the topic du jour post fourth quarter earnings reports coming over the next few weeks? Yes. But if the new Fed chair launches QE4 in May or late second quarter, third quarter, I would expect this lower to the right trend to continue in the bond market and its volatility. That would be bullish. So, pivoting back to stock volatility, long-time listeners of our investment content know we've discussed realized volatility, implied volatility, and forward volatility a number of times. Like many other indicators, market volatility waxes and wanes in cycles. Here's a list of a few stock volatility measures I like to follow and their levels on Friday, January 9th as of this writing. Investors realize stock volatility is a measure of an asset, single stock, or index actual historic price change over a period calculated from past price data, like intraday, daily, weekly, or monthly prices. The longer the time frame, the more data that's used, more often than not, the less volatile an asset class appears. Short-term extreme, high or low, get averaged out and smoothed out, and the performance and return wave and the expected outcomes narrows. For this video, I'll use Bloomberg's Spot Vol Index as our realized volatility reference point. That's exactly what's happening in the market on a daily basis in price change of the S&P 500, not what's expected in the future by implied volatilities that are used to calculate and trade options. Right now, Spot Vol is around 8.5. While not out of the ordinary, this is closer to its lower bound, which it can stay for a little while. But I like to compare this to all the implied volatility data points I can find. You know, the cost of hedging and buying puts to cushion the downside if the market drops suddenly. You can start with 1 day and 9-day implied volatility numbers that I only just discovered about 6 months ago. Right now, the options market is making you pay about 50% more to insure your portfolio over the next 1 to 9 days. Is this too much? Probably not. Why? Well, a lot of headlines have been swirling recently, both geopolitical, economic, and potentially legal, with the Supreme Court decisions imminent and anything you can come up out of left field that shocks the market for a few days or a few weeks. In fact, we got 2 to 3 of them over the weekend as I wrote this. Geopolitical issues in Iran, potential credit card interest rate increase limit thrown in by the president, and the biggie, the DOJ investigation into the Fed chair for building costs. Here's that chart on the 9-day volatility. Investors, also, given the low absolute level of all three indexes and data sets, I know that the granddaddy of them all, the VIX index, historical band, is around 12, x that record-setting no volatility year in 2017. Short-term measures look until go lower. Recall that the VIX index, the CBOE volatility index, measures the stock market's expectation of volatility over the next 30 days on a rolling basis. It's not traded. It's math. It's a math equation that uses the S&P 500 option prices and is known by many as the fear index because it reflects investor sentiment and the cost to hedge or buy insurance in your portfolio in the next 30 days. Viewers know I'm not a big fan of this index as it's not directly traded, but I do like to compare it to its trend and level as well as history and all those volatility products that are directly traded in markets, all futures. Here's that chart. Investors, I also like to look at the continuous contract curve of volatility futures. On Bloomberg, these are UX1, 2, 3, going out all the way 8 to 9 months. Those are January, February, March months, with them shifting to February, April in about a week. I found the most information and predictability in the UX2 and UX3 continuous contracts. Right now, these stand in the upper teens, while those farther out in April and beyond are above 20 and very close to the historic average of about 21.5. Here's the table of all futures prices. Investors, this structure says to me, as it has for a while, that very little is likely to happen over the next 2 to 3 weeks, but if so, the market could be jarred. But if so, the market would be likely jarred lower as opposed to higher. The market is likely to remain elevated as far as volatility with earnings reports hitting. However, this structure says to me that there is an open window in February through April that markets are vulnerable to news or an event that would jolt volatility higher and the markets lower. The good news is, should that happen, markets participants are likely to buy the dip if and when forward volatility futures cross 21.5, 22, and the front month of volatility curve rose and caught up with that. Say, down 10 to 12% on the S&P 500. The insurance markets of the stock market, the option markets, are hinting that buyers would flood in and the low would come fast and furiously for a mid-year rally. This is one of the key reasons we labeled last week's video patience after the Guns N' Roses rock ballad. The first half of 2026 is one of those years. The options markets are hinting at real buy the dip moment come later in the first quarter lower. The good news is that our investment team has experience in these types of markets. Remember, investors, that elevated volatility also means elevated opportunity for longer-term investors. Historically, investors' biggest incremental returns come from investing when volatility is high, not low, and markets are down, and others are either acting emotionally, or worse yet, being forced to sell when they really should be pushing their chips into the center of the table and adding to investments. What does this all mean to you? Our advice to you is keep following the investment content at Oak Harvest website and our YouTube channels. We'll be addressing our 2026 market outlook on January 29th in a YouTube live stream video with Troy, Charles, and myself. Send some questions in advance if you want any special investment topics addressed. Investors, whether you desire growth or income or a combination of both in your portfolio, the entire Oak Harvest team is here for our clients, doing what we can, planning for you, your family's future, regardless of what stage you're at in your career or in your retirement.